Hello and welcome to BloombergQuint. As we emerge from the second wave, we're obviously watching the near-term indicators, and some of those are suggesting that we're almost back to pre-pandemic levels, but those perhaps hide as much as they reveal. And beyond the immediate, there are far tougher questions to answer. What will lead India's growth in the next few years? Will consumption make a roaring comeback? Will we need government spending support for an extended period? Will it be exports? And what is India's potential growth? Joining us to answer all of those tough questions, or at least help us understand how to look at them, is Sajjid Chinoy, Chief India Economist at JPMorgan. Sajjid, thanks so much for taking the time to speak to us.
Great to be here, Ira.
Sajjid, I'll just start with the immediate, just to sort of get into the conversation. What is it looking like to you from the indicators that you're studying? Out of the second wave, things are starting to pick up, but I'm not sure how much we should rely on those indicators to get a sense of what the real state of the economy is.
That's right. I think the good news is that, we've bounced back in June and July. If you look at a weekly composite index of activity, we're back to where we were in March. The other piece of good news is that if you look at the labor market and look at the CMI numbers, employment to GDP in the month of employment to population, in the month of July is back to where it was before the second wave. So at least some of that, of course, has to do with sowing and the fact that it's that season of the year. But at least on paper, it would suggest there's no incremental scarring based on that metric. Now, if you look at the NREGA data, demand for NREGA even in July remains very strong, which is worrying. But as you hinted at, I think one needs to step back to not miss the forest for the trees. And when we assess India's recovery or recovery of any economy from this 2-year pandemic, it has to be where are we compared to a pre-pandemic path. And if you presume that absent any pandemic, India would grow at 6% in FY21 and FY22, which are not particularly heroic assumptions coming on the back of a 4% growth, then if India were to grow close to 9 or 9.5% this fiscal year, we will still be about 7% below the level of GDP will be about 7% below the level of output pre-pandemic at the end of this year. So there'll still be a meaningful shortfall that we will need to catch up on. And therefore, the larger question, given the imperative of growth in this post-pandemic world, where is it going to come from? Will it be consumption? Will it be investment? Will it have to be government spending? Will we get much juice from exports? And hence the focus in that report.
And I'll dive straight into that. I think consumption is something that everyone is tracking. But again, it's very difficult to get a picture of the whole. One will look at the auto sales, one will look at the FMCG corporate numbers, and some of those seem to suggest that there is momentum in consumption coming perhaps from the top 20% of consumers. Yes. How clearly does that tell us what the state of private consumption more broadly is?
Yeah, I'll make a broader point. I think we have to get used to a new normal here. The old normal, pre-pandemic normal in India was one where private consumption was driving growth, where private investment was constrained, at least at the top end, by balance sheets. So large corporates were constrained by their balance sheet problems. You had secular stagnation characterizing the global economy. Exports, therefore, were very weak, growing at 3% between 2012 and 2019. And you had a financial system that was chasing retail credit, even at the low end. And I'm going to argue that all of that has been upended in this post-pandemic world, that we cannot rely on private consumption, that the constraint on fixed investment has moved from balance sheets to utilization, that we're now in a global economy where the growth for the next 6 quarters will be the strongest since 1940. Exports have been surging in the last 6 months, and you have a financial sector that may become a little bit more risk averse, at least to lend to the bottom end of the pyramid. So I think all of those assumptions in this new normal will have to be challenged. Let me start with your consumption question. I think the key to understanding the prospects of consumption is to step back and understand where we were before pandemic. And while all of us celebrated private consumption growth between 2012 and 2019, I think there wasn't an adequate enough recognition that a lot of this was being driven by households running down savings and taking on debt. Just look at the aggregate GDP numbers. Disposable income to GDP between 2012 and 2019 fell by 2 percentage points, right? And consumption to GDP in that period rose by 4 percentage points. As a result, household debt, which began off low levels, so they weren't concerning to start with, almost doubled over a 6-year period. Now, borrowing to consume made sense for a young aspirational population when you have robust expectations about the future. This is just a way of smoothing consumption. But by 2018, as the economy was into the second year of a slowdown, our sense is incipient balance sheet concerns began to arise. Just look at the RBI's consumer confidence survey. What you'll find is by early 2018, the perceptions of contemporaneous income, after holding up well for 4 or 5 years, had begun to drift down or drift down even further. And so the key point I wanted to make is private consumption had begun to slow in early 2018, much before the NBFC shock. You see this in retail credit by banks. If you take out mortgages, it's even clearer that this starts in early 2018. You see this in the IP data, and you see this in the perceptions, the survey data from the RBI. This is important because there is a school of thought that says, well, consumption only began to slow after the 2018 IL&FS shock because of tighter monetary and lending conditions. If we can reverse those lending conditions, consumption will pop right back up. That's not the thesis that I'm working with. What we believe is it began to slow before IL&FS because of these balance sheet concerns. Now, if that's your hypothesis going into the pandemic, and you believe there's a fair amount of scarring through the pandemic, when I spoke about that 7% shortfall, the fact is employment to population will still be 2 percentage points below pre-pandemic levels. And just look at those RBI surveys. We got a survey Friday night from the RBI. If you look at income perceptions, employment perceptions, spending perceptions, general economic perceptions, these are much, much more depressed compared to pre-pandemic levels. In fact, they haven't even gone back to the March levels. So if households were worried about their balance sheets coming into the pandemic, and there's been more scarring in the pandemic, it's hard to expect that you're going to get a big booming consumption recovery. You will, of course, get pent-up demand, and we should not conflate that over the next 6 months with what the underlying trajectory of consumption is. But hard to imagine that with consumption slowing for 2 quarters before the pandemic, that after the scarring, consumption steps back up and starts going at 7-8%. There's no doubt that there is a price effect here. Real interest rates are lower. Monetary conditions are much easier. But I would argue the income effect on the balance sheet will swamp the price effect. One last data point, there are all sorts of data points, but let's just take the auto sector since you brought it up. If you go to between January and July, look at the actual registration data of autos, four-wheelers and two-wheelers. Compared to 2019 levels, which is a baseline, four-wheelers are down about 7%, two-wheelers are down 30% compared to 2019 levels. So, and this ties up with the RBI survey where when households are asked, where will your discretionary consumption be? These are record depressed levels by the standards of that survey.
Interesting. Let me throw a few counter questions at you just to sort of, get a clear sense of what you're thinking. So there is one hypothesis out there that given a large part of the discretionary consumption perhaps comes from the top 10 or 20% of the Indian population, and these are the people who are at the top end of the K-shaped recovery. They're feeling the wealth effect from, higher asset prices, capital markets, etc. And that is the segment which will sort of push consumption in the post-pandemic world. Yes, unfortunately and worryingly, inequality has deepened, and the lower income end of the population has taken a hit. But they may not, sort of drive the boost to consumption even in normal times. Do you buy that?
Well, I think, again, we should kind of maybe not conflate one-time effects with more enduring effects. I completely agree that the top 10% account for a large bulk of the consumption spending. But think of what we're saying. If it's pent-up demand, if there's excess savings like US households have, that's a one-time impact. Whereas at the bottom of the pyramid, if you've got the bottom 20 or 30%, who've either lost their jobs or have heightened income uncertainty and have to raise precautionary savings, that's a recurring impact. Number one. Number two, when we think of a K-shaped recovery, my sense is, and this is not just true of India, this is true of many countries around the world, when the dust settles on the pandemic and you break up GDP by income shares, we should expect to see income to GDP of the top end go up for the reasons you mentioned, and income to GDP of the bottom go down. Now, essentially what that means is income is being transferred from the bottom to the top. And for every $1 that moves from the bottom to the top, the marginal propensity to consume is actually lower at the top than at the bottom, right? So in the steady state, one should expect consumption to shift down, not up. And we just have to look at last year's numbers. We now have the data for all of FY21. There was a belief that private consumption drove the entire recovery between September and March. But we now have the data. Among all the drivers of demand, consumption, investment, government spending, exports, consumption was the slowest and the weakest to recover back to pre-pandemic levels. The recovery in the second half was driven by massive public investment by the central government, where capex grew by 75% in the second half. Exports played their share in the Jan to March quarter. So government spending, investment, exports recovered to pre-pandemic levels much faster than consumption. So I'm a little bit more cautious on that hypothesis that, this pandemic's over and consumption will be back to the rates we've seen in the past.
Fair enough. On the question of household debt, again, like you said, the data clearly does show that uptick. On a global scale, I saw a chart in your report as well. It's not like household debt is very low in India anymore. So certainly that could play a part, even if there is willingness to lend. For instance, there are a host of NBFCs, fintechs, etc. We see money going after small ticket consumer lending, but the income effect, as you said, if you don't have the sort of income to repay those loans, perhaps you'd be that much more cautious.
That's right. So to be fair, again, India's household debt, and we need to be careful here that the data, we've had to splice two series. There's data from the BIS, data from the RBI, we've spliced them too. But we're still below emerging market averages. So it's not like household debt, is a binding constraint, but all of this is contextual. I think levels of debt influence consumption when interacted with expectations of future income. If you've got robust expectations about the future, then even higher levels of household debt don't become a binding constraint. The worry really is that given the scarring and given how we came into the pandemic, households, at least in those surveys, multiple surveys, seem wary about the future. And when that happens, they typically tend to retrench. So I think it's going to be those expectations married with the levels of debt that perhaps in the near term become a bit of a constraint.
On the investment side, again, it will probably be an interplay of the ability to invest, because I think as your report and others have also pointed out, there's been quite a dramatic shift in terms of the sort of deleveraging that we've seen in large corporates. So they have the firepower, but then whether they use it and they have reason to use it, I guess, is the question.
Absolutely. I think this is the good news, that if you look at investment, for a long time, we said twin balance sheet problem. The constraint was, large corporate debt and NPAs on banks. That has evolved now. And I would argue that that's no more the constraint. If you look at debt to equity of the listed universe, the last data that I saw in 2020, we're back to levels of 2006. So I'm not sure that that's a binding constraint necessarily anymore. Top 100 companies, profits, EBITDA grew by 17% this year. That's all good news because it creates space on their balance sheets, puts them in a much better position to invest. The binding constraint instead has become demand. And you have to look at the RBI's manufacturing utilization surveys to recognize that utilization was below 70% for 2 quarters, even before the pandemic started. And this is the first time it's happened that utilization in that survey, which goes back, I think, to starts around 2007, 2008, that utilization dipped below 70. And 6 quarters later, we're still below 70%. So I think the good news is that the large corporates are in a much better place to invest in the next investment cycle. The binding constraint today is demand. Investment is endogenous. It needs some driver of demand to actually react to. And we shouldn't forget, however, the role of SMEs. I think the one risk here is SMEs. If you break India's investment down into large corporates, household and SMEs, and public, the fall in the last decade has been households and SMEs. And to the extent that SME balance sheets will most likely be hit more, they could provide a bit of an offset. But I think for investment, for me, today the constraint is demand. And the question we must ask ourselves, therefore, is if demand is the constraint and private consumption will not deliver that demand in the short run, where can that demand come from? People are looking at C&I. We think it'll have to be X and G.
Okay, so let's move straight into that. Let's move into exports. Is exports going to be some sort of knight in shining armor here, given that we?
Well, yeah, I don't want to overstate the case. I mean, it must be said for the record that between 2002 and 2010, that was the driver of growth. Exports grew at 15% per year for almost a decade. That drove the investment cycle, that drove growth. Consumption was a lagging indicator.
And I will never forget an interview with Jahangir Aziz, who said, we think of ourselves as special, but we're just another vanilla economy which grows when the world grows. Is it
So
back to
that was a bit of hyper-globalization. And we actually had found that the elasticity of India's exports to global growth is still very strong. And it's particularly true because India's export basket has changed. There used to be a lot of gems and jewelry, leather, textiles. A lot of it is now engineering goods, capital goods, auto parts, pharmaceuticals. And those elasticities are actually higher to the global growth impulse. Now, underlying all of this, Ira, is a very different interpretation of the world. I mean, till 2 years ago, we were seeing secular stagnation, global growth at less than 3%. Where will that impetus come from? Right now, this is a new normal we're living in. Unprecedented fiscal and monetary stimulus from developed markets. And the fact is, over the next 2 years, we expect developed markets to grow at 5%, right, versus a 2% average pre-pandemic. And given the reopening and the vaccinations progressively in emerging markets, even they will grow above trend. So at least for the next 6 to 8 quarters, notwithstanding near-term concerns about the Delta variant, we're looking at global growth being much above trend. And that, all else equal, should provide a meaningful tailwind for India's exports. We're already seeing that. If you just look at manufacturing exports, they're almost 20% higher than pre-pandemic levels. Now, to be careful, a lot of this reflects higher commodity prices, steel, other commodities. If you deflate them out, even then, once deflated, manufacturing exports are growing in double digits. The growth has been almost 10% between January and June. So I think one clear tailwind can be exports growth. This is quite different from what people say, the IT industry will do well because the pandemic has accelerated technological adoption. That's a more secular story. I'm referring to more cyclical story over the next 6 to 8 quarters, which should drive India's manufacturing exports.
So we should be able to get some upside from growth, even if one doesn't grow in terms of share of export. I haven't looked at the data, but I'm not sure if our various reports and committees in an attempt to raise our share in exports has worked or not. But even without that, we will see some upside.
That's right. This is purely cyclical. This is a rising tide lifting all boats. If in fact, our forecasts are right that global growth is going to be above trend for the next 6 to 8 quarters, then just that should be, even if our share doesn't change, that should give us a lift in exports. I mean, part of this also, just to make this a little global, is this recognition by DM policymakers that there was possibly a policy error in 2010 when fiscal policy consolidated too quickly in the US and too quickly in the Eurozone, right? And in retrospect, that was seen as a mistake that choked the recovery. And therefore, you're seeing much more expansive fiscal policy in the US, in developed markets. That should lift global growth, and that should give emerging markets like India something to work with.
Just to stay with the global picture and detracting from the growth conversation for a bit. So we've seen commodity prices having risen. They've corrected a little bit in recent days. But net, given the upside that we could see from export and the downside we could see from higher commodity prices, how does that play out in net for us?
Well, so two things here. I think that the most important price to look at is crude prices. So you're exactly right that to the extent that global demand is stronger, we should benefit from exports. But if crude is going to average $75 a barrel this year versus $45 a barrel last year, that's a 50% increase. That's a negative terms of trade shock, and that's going to hurt the economy no matter whether it's absorbed by the public sector through excise duty cuts, or it's absorbed by the private sector through higher inflation, margins getting squeezed for corporates. That is the risk we'll have to live with. The net impact is, if we get the kind of export growth that our elasticities suggest, the net impact from the global economy should still be positive. So that export growth over the next 6 to 8 quarters should offset the negative terms of trade shock from higher crude, and therefore the net impact is still positive.
And net exports is a significant contributor to GDP, just for...
Yes, I mean, to be fair, exports are about 20% of GDP. Again, I don't want to overstate the case. We've made the case that both exports and public investment have to do the heavy lifting in the near term. Exports are 20% of GDP. One would argue the value add of exports is 2/3 of that. So the net impact is closer to maybe 13 or 15% of GDP. Public spending is probably 15%. So you're asking 30% of GDP to do the heavy lifting. But these have to serve as catalysts. If they serve as catalysts, you set in motion a series of events that causes utilization rates to go up, that begins to heal household balance sheets, that creates some employment impulses that can eventually trigger consumption and investment. So I keep saying exports and government and public investment have to be a bridge over the next 6 to 8 quarters before consumption, and giving time for consumption investment to recover.
Understood. And what are the indicators suggesting about public investment? I think the April to June fiscal data was reasonably encouraging in terms of just the spending side. I think capex was reasonably high compared to previous quarters.
I think it's very encouraging that the government, is determined to push public investment through. We saw at the central level, as I mentioned earlier, from October to March, capex grew by 75%. Both the central and state budgets have 30% growth in capital expenditure this year. I think 30-35% growth. So all we need to happen is for those budgets to be executed. No one's asking for new fiscal resources to be found and more public investment to be done. Just those budget plans need to be executed. As you said, April to June, revenue expenditure net of interest contracted 7%, but the central government plowed through with the capex, which grew almost 25%. So that's really encouraging. And to the extent that we may see some positive surprises on the revenue side, that hopefully will not impinge on these capex plans later in the year. I think what's important to monitor is whether the states can carry on, or can actually execute on the high capex plans that they've budgeted. I think the center seems to be on that track for sure. In the case of states, very often this capex gets cut in the last 6 months or 3 months. And this year, as we've discussed before, the state deficits are already below the 4% that they should be targeting under the glide path. And in fact, even after that, their borrowing number for the first 5 months of this year is 15 to 20% below last year and below what they've budgeted for this year. So we don't want a situation where states become too conservative, overdo the fiscal consolidation, and public investment gets cannibalized. I think the center will do well to nudge states to say it's okay to borrow a little bit more if in fact that borrowing is going towards fructifying your public investment plans. I can't state enough that when you have a consumption slowdown, it's the job creation and the income certainty that provides that will help. And so doing this infrastructure spending will create jobs, can hopefully crowd in private investment, and also boosts, as we'll discuss, total factor productivity.
And we'll get to that. So let me dive straight into that, and you'll have to put on your professorial hat here. Firstly, to explain to us, sort of the debate over, or the discussion over potential output, and why it's important to have that right now, and why you're focusing on it.
I think the growth imperative never felt this urgent. And I'm talking about emerging markets more generally. Coming out of this pandemic, let's take the case of India's debt. Public debt's going to be 90% of GDP. And for that debt to be sustainable, it's really going to be all about the denominator and how growth evolves more than the actual pace of fiscal consolidation. That if we can target real GDP of 6.5-7%, so nominal GDP is 10%, then even a more gradual pace of fiscal consolidation will first stabilize debt to GDP and then over time bring it down. If, God forbid, nominal GDP were to be closer to 8%, then no matter how quickly you consolidate your fiscal, debt to GDP keeps rising. So both for job creation, ameliorating incomes and debt sustainability, potential growth and medium-term growth never felt this urgent. The other reason one has to have this discussion is a little bit, I'm going to veer towards monetary policy. One of the big puzzles has been that India has experienced this large contraction last year. Even when we recover, will be 6-7% below the pre-pandemic path. All of this should be very disinflationary. We should have seen core inflation plummet and plunge, and yet core inflation has been stuck around 5%, slightly higher than 5% now for 15, 16 months. And the question is that telling us something about the supply side that we need to take into account going forward? I mean, we've seen this K-shaped recovery where large firms have grown their market share. Is that resulting in higher pricing power? Has the impact on SMEs and therefore competition on the supply side been more than we think? These are all telltale signs that looking at potential output afresh is going to be very crucial going forward.
And you're sort of, honing down the analysis of the supply side into one aspect, which is total factor productivity.
So it's a very limited aspect, with all humility, because I think every element of, so if you think of, output, GDP is essentially a function of capital stock. It's a function of labor force, labor, which is population growth times labor force participation. It'll be a function of human capital and educational attainment. And then it'll be this catch-all term called total factor productivity, which is a proxy for productivity of the different factors of production, allocative efficiency in the economy. And what we're seeing is there's been a fair amount of talk on investment. We've discussed the fact that investment has now moved from balance sheets more to utilization. I'm going to be humble in saying that the impact on human capital around the world from people being out of school for 17, 18 months is going to be large, sustained, and really beyond the scope of our analysis. I think, experts in that area should focus on it. We're just taking a small sliver to say everyone's focused very much on the investment slowdown over the last decade. What we've kind of neglected is the role that productivity growth plays to output. If you look at India's kind of growth in 2005-06, TFP contributed 5 percentage points to potential output back in 2005-06. And this was true of all emerging markets. That was the kind of the golden period for EM productivity growth. That in our computations has halved. Before, this is all pre-pandemic, it's come down to 2.5 percentage points. So quite apart from what higher investment will get us in terms of potential growth, we also have to look very closely on productivity growth, which is half. Now, this is over a 15-year period, so it's a long-run problem. What are the 3 factors that we think influence it? At least the empirical analysis finds that trade openness is an important correlator of TFP growth. So we want to remain open. We want to take advantage of this export boom. We want to keep imports free, because in this new world, you need imports to re-export. So trade openness is a crucial determinant. The financial sector is a crucial determinant. And this should be very intuitive, that ultimately how an economy's savings are allocated comes down to how efficient the financial system is. And the third is public investment. So none of these are non-intuitive, but we find strong empirical support that the health of the financial sector, how open an economy is, and whether we get sustained public investment have a crucial role to play for TFP and therefore eventually for a potential growth.
And there are policy lessons one can glean from the importance of these aspects. Some of those are perhaps already work in progress, but there may be others which need more attention.
I think so. I think the public investment is a very good push, and I really hope we can sustain that over the next couple of years. So we have to find fiscal space somehow, whether it's privatization, whether it's tax reform, whether it's rebalancing expenditure to make this public investment push going. I think the financial sector, again, the budget makes a good start by saying we want to privatize 2 public sector banks as a signaling mechanism. I think really important that get carried out. We've spoken at length over the last 2-3 years about the financial system and how risk averse it had become. I would argue that's not a binding constraint today because demand has to pick up. But when demand recovers, it is possible here that the financial system does become a binding constraint to that 7% real GDP growth. So I think that will need a lot of work. We've seen a lot of risk aversion by public sector banks. So I think that's a supply side issue that will need work. And I think it's just starting off by doing what the budget promised will be a good start. And I think the third thing is, trade openness. There's a lot of research on this to find that ultimately, and in a way, it's not surprising because trade openness forces upon you the ingredients of higher productivity growth. It forces firms to reach a critical mass. Larger firms are more productive. It exerts greater competition, which results in higher productivity growth. It forces regulatory policy to be very nimble. So in a way, open economies tend to exhibit these characteristics just to survive in a global marketplace. And I'll just end by tying this back to the very first question you asked about consumption. See, for consumption to sustain, ultimately it has to be driven by income growth, organic income growth. And for income growth, you need high wage growth. And in all else equal, wage growth is a function of productivity growth. So in a way, these are not unrelated concepts. If you can boost productivity growth, wages will go up. When wages go up and incomes go up, that creates the conditions for more sustainable consumption.
As a last question, Sajjid, I'll just circle back to sort of where I started, but link it to policy. Now, we've already discussed the importance of public investment. We know we have a fiscal runway, which perhaps permits some of that. We won't get into the nitty-gritties of the monetary policy side, but what are the policy mistakes to avoid at this stage? Acting too soon, seeing some of these, sort of near-term demand indicators starting to look better. What are the policy mistakes we should stay away from?
I think diagnosing the macro situation becomes very important, which is why we wrote this report to say it will be tempting. And there's always a clamor from the analyst community saying, well, consumption is going to bounce back. We're seeing pockets of private investment. And if we misdiagnose the situation, like the US did in 2009-10, policymakers 10 years later say we tightened fiscal too much too soon, believing that the global economy was bouncing back. So I think the first is not to conflate 3-month, 6-month pickup in consumption with a more durable consumption recovery, not to conflate some pockets of investment in the commodity sector with a more broad-based private investment cycle. And so I think the first issue will be not to over-tighten fiscally too quickly, especially not at the risk of higher public investment. I go on like a broken record. Getting the 6, 8, 12 quarters of public investment by the center and the states. I think the states is as important. Their capital formation is twice as large as the center. So nudging the states and working with them to do that, number one. Number two, I think, we need to stay open. Import tariffs are like export taxes. This is an environment where we'll get a cyclical pickup because of the global recovery, but also COVID has only accelerated this China plus one hedge. Multinational companies are looking for other avenues in the region. We need to capitalize on that. So I think these are, and third, I would say, over the next couple of years, start thinking about where to generate more fiscal resources. The only way that fiscal deficit can go from 7% to 4% is not to hack expenditure, but to find other sources of revenue. On the monetary policy side, I'm going to venture out to say, one, I understand the dilemma the RBI is in. Growth is below your pre-pandemic level. Inflation has been much above. But one thing we have to keep a very watchful eye on is inflation expectations. That we've actually seen household inflation expectations rise by, between 250 and 300 basis points, depending on when you start counting. And one of the dangers of that is if inflation expectations go up, then the trade-off you have between actual inflation and the output gap becomes less favorable. In the sense that when expectations are elevated, then even when there is slack, sometimes you can get higher inflation. And the whole idea of inflation targeting is to bring inflation expectations down so that you get a better trade-off between slack and actual inflationary pressure. So I think in my mind, fiscal has to do the heavy lifting this year, execute public investment. If monetary policy has to consolidate and normalize to ensure that expectations remain anchored, that is the right balance to achieve, I think.
All right, Sajjid, I'll leave with that. Thank you so much for taking the time to explain this to us. Appreciate you speaking to us here on Bloomberg.
Pleasure, Ira. Thank you. Thank you very much.
Thanks for watching.